The following is an update and technical analysis on the U.S. bond market, followed by the 2-year yield, 5, 10, and 30-year yield based upon the daily realm where we've had some headlines rock the bond markets, where we've witnessed a sharp turn due to an unexpectedly high producer price index, a more hawkish stance than anticipated within the Federal Open Market Committee minutes, and escalating tensions within the Middle East, where the ongoing trade continues to be where conflict spurs demand for both military ordnance and reconstruction projects, which is now just bolstering optimism within the stock market, where this evolving landscape has given us a better sense of the potential magnitude of rate cuts for the following year, where there's been a notable increase in expectations for additional rate cuts within the coming year over the past few days now. And here we are deep diving into the 2-year treasury yield based upon the daily realm, and we are testing a major primary reactionary uptrend line based upon just a series of reactionary lows really across the board. They're splitting and undercutting the 50 exponential moving average, and we are backtesting this key pivotal inflection point as of now, where bullish traders or long traders of the 2-year bond have an objective long trade entry, if not a short end to short on a short trade setup for the 2-year yield on a potential retest, backtest of the primary reactionary uptrend line based upon the 2022 April reactionary lows. And that is a monumental, a 2-year, multi-year major price support level correlated with the 236 fibs retracement and the 200 exponential moving average hovering up above, coinciding with that bottom of that trend line. And that will be a monumental, key pivotal inflection point if and when we go on to retest that key pivotal inflection point. We have a big divergent high now, big clear, big divergent high. We have a 2 out of 4 momentum indicator, bearish and negative near-term divergences really constructed amongst multiple indicators there, aside from excluding the oscillator and the stochastics 1033, where we are now revisiting and retesting the zero line thresholds of the moving average convergence and the oscillator. So the halfway point within the technical momentum indicator dimensions are at a critical juncture, again providing an objective, which what I would call an aggressive short trade setup on the 2-year yield, which would be long the 2-year for bullish bond traders. On the 2-year, that would be a critical inflection point, whereas short sellers, they want to see a complete recovery of this yield's primary reactionary uptrend line on a re-challenging of the 509 price resistance, just a very key inflection point, big resistance level right up above, where we had a head fake whipsaw-like reaction, backtested multiple times, and we finally broke down this minor uptrend line. But again, short sellers, they want to see a revisiting of the 1 fibs, 0 fibs retracement, called the 5203 price resistance, for a prolonged sell-off in the 2-year, ultimately re-challenging the negative and bearish divergences that were constructed on multiple indicators here. Short sellers, aggressive short sellers, bear traders, this would be, again, it's just a very aggressive long trade entry. Taking you to the 5-year daily, off the daily interval here, 5-year yield, and we are breaking down off this primary reactionary uptrend line off the May 2023 reactionary lows. And this, again, just a major key inflection point where we actually gapped down and we backtested. We ended up backtesting that primary reactionary uptrend line, and we have been rejected thus far. So again, long trade, a bullish trade for the 5-year, which I would continue to call an aggressive long trade entry for any 5-year bond bulls on a prolonged move, on a revisit of the yield of the 445 price support level for any short sellers and or bear traders to hone in on for an entry point on a revisit of this primary price support of the top of the primary trading range, which I believe will be the most critical transitioning point off this multi-year primary trading range price support if and when we go on to retest that key pivotal inflection point. Once again, short sellers would provide a great risk-reward ratio for any short sellers and or bear traders upon revisiting the 440.55 price support down below. A continued disruption in sell-off in the 5-year treasury note. Again, very objective for a long trade entry for a move to the downside for any bull bonds of the 5-year. But again, I believe it is an aggressive long trade entry, in my opinion. Whereas we do have a confirmed divergent high off this bearish falling wedge pattern. We have a confirmed bearish crossover here in the moving average convergence. Again, very bullish there for the 5-year bond, where the stochastics 1033 and the oscillator, again, have negative and bearish divergences amongst multiple 3 out of 4 indicators, barely touching the equal highs, if not exaggerated divergence here in the relative strength index technical momentum indicator. Taking you to the US 10-year yield based upon the daily interval here, and we are just a monumental big divergent high with negative and bearish divergences, huge divergences on all 3 technical momentum indicators. And we have a confirmed bearish crossover there in the moving average convergence, and just a monumental key inflection point I've been hyping up for quite some time here, right off the 2020, call it 3-year, multi-year price support level. And that will be the line of the sand. That is going to have strong implications for the housing market, government issuance of bonds. That is going to be the line in the sand, in my opinion. And that will be the utmost great risk reward ratio for any short sellers and or bear traders who are looking to get in an entry point for that short trade setup on a prolonged sell-off of the 10-year yield for a much stronger move to the upside. Whereas the long traders, bull traders, they want to see a solid breakdown here in the US 10-year yield primary uptrend line, which would spell out major sell signals, especially on a red solid candle close, shorting the 10-year yield. That, I believe, would increase the odds for a next year and then re-challenging of the 4208 price support, major price support level there, based upon a multi-reactionary high and low. And that, in my opinion, will spell whether we get any rate cuts sometime next year if the bond market begins to bet on multi rate cuts and a very significant paradigm shift within the bond markets if and when we go on to break this key price support level on a prolonged sell-off in the yield down to the 3.918 price support level there. So keep an eye on this major monster monumental trend line there if and when we go on to retest it, taking you to the 30-year. And wow, what a complete huge bidding in the 30-year yield here. We're completely gapped down, and here we are just again selling off in the yield there with a solid red candle close. Very bullish for any long traders and or bull traders in the bond there, going on to re-challenge the 458.9 price support level, which coincides with the 1 Fibs retracement. And then ultimately we have this primary reactionary uptrend line here based upon the August reactionary lows. And this will be the utmost key pivotal inflection point for any short sellers and or bear traders looking to short the 30-year yield on a prolonged move, on a potential prolonged move for yields on a bigger run to the upside if and when we go on to re-challenge that key pivotal inflection point. Whereas again, long traders and any bull traders of the 30-year bond want to see a final solid red candle close breakdown in the yield here, taking out the 1 Fibs retracement on a reactionary bigger move down to the 786 Fibs retracement, call it the 4382 Fibs support there. We have a confirmed bearish crossover in the moving average convergence. Again, would it be a long way down? No divergence here whatsoever, but again, just something to keep an eye on where we have some sort of beginning, foundation and or stage on a first stage setup of technical damage within the 30-year yield, MACD, and multiple indicators if and when the bond bidding continues on the move on the safe haven trade while an all-out war breaks out in the Middle East.